So it's not what you do that matters in terms of which exit route you choose, but the way that you go about making it happen. And I must stress that you can't start planning this process too early. One of the key things I tell clients is that when planning their exit, they must spend time now thinking about what they're going to do once they've left their business. I'm afraid that all too often this is the last thing that happens, if ever, and they then end up being disillusioned, often starting another business out of boredom. Having said that, for some of you, starting a new business is what you want to do anyway, but regardless, your exit should be about enjoying the next chapter of your life, whatever that may be, so start planning for it now. To that end, it's really, really good to dream. One of the first things I ask clients to do is to find a picture or several pictures and create a mood or vision board that shows what they want in their future. And then I tell them to stick it on the fridge door. Why on the fridge, you might ask? Because every time they open that door, they'll see it, which reinforces what they're trying to do. But more importantly, their family will see it, and their friends when they come round. And they'll definitely ask why it's there. As you may be aware, it's well known that each time you explain something, you're actually embedding it deeper into your psyche, which should spur you on to make it happen. Now, probably the most important thing about this whole exit process is planning. And the key thing about planning is the vital kiss. Keep it simple, stupid. The exit process is complex, with many moving parts, so having a simple plan makes it much more likely that it'll succeed. So what's needed in your plan? Well, the first thing obviously is the route. Are you going to look for a trade sale, or are you going to merge? Are you going to IPO or arrange an MBO/MBI, or another one of the routes I talked about earlier? 2. Decide what professional advisors you need to help you achieve it. 3. Decide, possibly with the help of the advisors you've just hired, what's the value of your company. You'd be amazed how many people start this process without thinking about this. You need to have a magic number in your head of what your company is worth to you. Of course, it's only worth what someone's prepared to pay for it, so try to be realistic, but it's important that you have a figure in mind. Because if the initial offers from potential buyers fall well short of your figure, either you've got to have a rethink, or something's wrong in the way that you're promoting your company in the marketplace. Then think about how the buyer will value it. Will their valuation be based on some multiple of profit in the traditional way? Or are you operating in an industry where valuations are based on a multiple of turnover with known recurring revenues, as often happens in internet businesses? Or some combination of the two? Your advisors can help you here. So what is this multiple I keep mentioning? You'll often hear the term multiplier bandied about in M&A conversations. This is another magic number used to describe how many years of profit or turnover, often averaged over the last 3 to 5 years, that it would take before the buyer breaks even on the deal, or put another way, gets the money back used to buy the company. Unfortunately, the multiplier is only known after the deal is done, so when you're told that your company will sell on a multiple of X, you can't rely on it. Oh, and there are actually 2 multipliers. This one, which everyone talks about, is actually the seller's one, but you can bet your house that the buyer has their own, lower one. Before we go any further, it might be an idea to talk about profit in the context of an exit. Normally this is EBIT, earnings before interest and tax, adjusted for something called write-backs. To those of us in the exit space, write-backs are often known as directors' whims, things that are not core to the business but which give the directors or owners a benefit. Let me give you an example. A friend of mine is a motorbike lover and had a Kawasaki Z1300 on the company books as a fast response vehicle, not that his company needed one. Needless to say, this got written back when he sold the firm. Exit professionals can tell you countless stories of owners having put things like horse boxes decorated with company colours on the books as a marketing or promotional expense because a family member just competed in show jumping or eventing competitions. Even today, I'm still surprised at just how inventive owners can be. Anyway, these write-backs are added to the profit for the purposes of the valuation calculation. But the opposite also happens. You're leaving your company, so it's likely to need a new CEO managing director to replace you. so the annual cost of this person is added to the cost base for this calculation. The purpose of this exercise is to give you and the potential buyer a more accurate picture of the financial health of your company. 4. Test everything. You need to devise tests to validate your valuation for any potential buyer to take it and you seriously. This means doing a forensic examination of your business. When I did that in my last company, it showed that I could leave the business. I was actually driving to work one day when I suddenly realised that the team I'd brought in to help me run it no longer needed me to guide them. This was the light bulb moment that told me that it was the right time for me to sell. So what should you be looking at? Well, this is far from an exhaustive list, but I'd start with your margins and the return on investment on things like your advertising and marketing spend. Then I'd be monitoring things like customer loyalty, staff churn, and whatever else is important in your industry or sector. But as I say, this is something for you to figure out, as no two companies are the same. Never forget that things change. Who foresaw 9/11, or the 2008 financial crash, or the COVID-19 pandemic? You need to review your plan and retest it regularly, and don't be afraid to update it as a result. This becomes part of your backstory, which will give any potential buyer comfort. Just before I exited my last company, we had 9/11, a complete left field event that had a massive impact on what I was trying to do. We'd been planning to float on NASDAQ, but 9/11 put paid to that, and we ended up with a trade sale, much to my frustration. 6. You need to manage your expectations. I mentioned earlier that the exit process is complex, and this complexity is going to eat up time and money. On average, in the UK, it takes between 9 and 18 months to sell a company, from the time you take it to market to the time you receive money in your bank account. Towards the ends of this lecture, I'll talk specifically about costs, so I won't go into much detail now, but I do want to mention time. It's not just your time that you've got to consider, but also that of any staff that you need to get involved, particularly during the due diligence process. You need to be prepared to do a lot of work outside normal working hours because you still need to be running your company while the process is happening. A lawyer once told me that on average he received around 4,000 emails per deal. If a lawyer gets that many, and that's just one member of your team, how many do you think you're likely to receive? In terms of cost, there's the professional fees, there's your time and your staff's time that you're going to have to pay for. And then there's the cost of coffee, because you're all going to be drinking a lot. Now, I need to make you aware of something called an earnout, which is the term used for bridging the gap between what you and the buyer believe to be the future of your business. An earnout lets you receive more if agreed future performance targets are met. The problem with earnouts, from your point of view as the seller, is that you no longer control the business, and so are reliant on others to deliver the performance needed to hit target. I've known many instances where earnouts are not paid because the new owner moves the goalposts. Let me give you an analogy. It's a bit like saying we agree to go on a road trip from New York to Chicago as part of the deal, but now I own your company and I think, heck, it's the middle of winter and it's freezing in Chicago. I'd rather go to Miami. So how many towns and cities on the road to Miami are the same as those on the road to Chicago? Answer, none. When buying companies, I always insisted on an earnout. I'll leave you to work out how many I actually paid. So how do you minimize the danger of earnouts? When selling my companies, I always ask for 2 offers from potential buyers, one with an earnout and one cash only. The one with an earnout needs to detail the amount of cash on completion so that it can be compared to the cash-only deal. If the amount of cash is similar in both, you might as well take the earnout as you've nothing to lose. But in my experience, that's rarely the case. The advantage of the cash-only deal is that it gives you as the seller certainty. And for many people, that certainty is worth paying for.